All right, the meeting is live. This is the CCM Investing Power Hour number 46. We're coming up on number 52 here shortly. We may have to do a special episode as we come on our 1-year anniversary. My name is Brett Schafer. I am joined by my co-host, Ryan Henderson. Today is our Power Hour episode where we analyze anything really in the investing universe. We can do earnings, which since it's the middle of earnings season, we're going to be covering a lot of earnings this week. We can be doing anything broader, anything more thematic. We can be doing financial news stories, really anything that comes to mind. And the only rules are we have to bring 2 topics each, and it lasts an hour. And it goes live on YouTube every 12:30 Eastern time on Thursdays. Okay, before we get into it, this episode is presented by stratosphere.io, our investing home screen for fundamental research. Throughout this episode and really all our episodes at Chit Chat Money, we're using Stratosphere's dashboard tool. We're using their nifty newsfeed, SEC file aggregation, and especially their fundamental charting tool to compare companies. And there is plenty more that Stratosphere has to offer. And the best part is you can join for free. We know that if you are looking for a really robust dashboard tool or any sort of investing home screen for yourself, a lot of the good ones, you have to pay up a big amount of money. Stratosphere, the best part, it's free. And if you want to upgrade to their their paid plan, you can use our promo code CCM for 15% off. That is stratosphere.io, ditch Yahoo Finance. I know we're going to be mean to them, but seriously, it's much better than that. And try stratosphere.io. Okay, Ryan, your turn. Why don't we
well, let's start with you. You are in
a new location,
South America. I don't want any of our Chilean fans to come knocking on your door, but you're in Chile. How is it?
It is good. It is hot. I would describe it as kind of Central California weather, but less, a little more mountainy. So yeah, but it's been good. I've only been here a day, so I'm kind of just settling in, and I'll be here for the next few months. So no really news to report. Maybe in 2 weeks we can get a short report back, because I've really just been unpacking and figuring out my grocery situation. So nothing exciting, but yeah, the Wi-Fi seems to be working well, which is good. That's the most important thing that Ryan was nervous about.
Brett's got a new mic, so if his audio sounds a lot better than mine or something, let us know, because I bought one. I got to hook it up, but we'll be upgrading the mics here soon. We got these odd looking headsets, but I guess they make us look semi-professional. Doesn't matter. Let's it's
I did check. I think 1% of our listeners are from Chile, so maybe there's 10 people in Santiago. Ooh. If you're here, let me know. Let's chat it up. I'd like to see you.
Yeah, definitely. Well, it's earnings palooza season. I think every finance show, anytime there's earnings season, calls their show earnings palooza. But anyway, there's a couple of ones that are pretty interesting that I've looked at this week. Airbnb, Roblox, Upstart, Zillow was kind of interesting as well. I know you're going to be talking about Charlie Munger. He had the Daily Journal annual meeting. There were some funny tidbits in that. Anything else? What else are you talking about?
I had Roku earnings, I think were interesting. And then did you say Airbnb as well? I thought that was a very fascinating report. There's a lot of, narrative out there about Airbnb, a lot of discussion. And I think if you look at the data, it can be a lot more illuminating. Some stuff we've been right on and some stuff we've been wrong on. I said actually wrong, we're wrong a lot, but some stuff we've been wrong on as well.
Yeah, why don't we start with Airbnb? This was just in general, I feel like every report I've ever looked at this quarter, I've thought here's the pros, here's the cons, there's some good parts, bad parts, that kind of thing. Airbnb's was just an exceptional quarter all around. Probably the best quarter I've looked at this earnings season. Revenue grew at a healthy rate, even in spite of foreign exchange headwinds. They did $8.4 billion in revenue for the full year, and probably going to be on pace to do more than 10 billion this year. They generate tons of free cash flow, more than $3 billion in free cash flow. and they returned a lot of that cash to shareholders. I think they bought back $1.5 billion this year.
That was nice to see. Yeah, they just ramped that up as well.
Yeah, it's really just kind of, I don't know, just impressive across the board.
Do you want me? I have some other key metrics from there that I think would be interesting to discuss.
Yeah, go for it.
Just for the audience, quick. Here's two. I don't want to throw out too many, but they had a gross booking value, which is basically all the dollars flowing through their platform at $63.2 billion, up 35% year over year. And that is from fiscal year 2022. So this calendar year. And the nights and experiences booked were 394 million, up 31% year over year for the full year 2022. And then the fourth quarter slowed a bit, but 20% year over year growth for both of those. Any big takeaways from you, Ryan, outside of this is, they're doing well. And for the people like us who have been, watching Airbnb and focusing on the valuation, that, or excuse, when we're focusing on the valuation, what I mean is we've liked the company. I think you'd agree with me there, but we're a little bit skeptical about the valuation. This is disappointing because we hope they've had, as the stock's gone up here, we've hoped that they would have like one bad report and the stock would tank and we kind of get a chance to buy, but that has not materialized yet.
No, and maybe the thing that stood out to me the most, and I saw a lot of people quote this, they said, compared to 2019, our headcount is down 5%, while our revenue is up 75%. I can't think of any other company where that's the situation, especially any other tech company, big tech company say it. So, I mean, it's, I think I used to have some bad takes about Brian Chesky. I used to say, like, I don't know, something rubs me the wrong way. I was wrong. This guy is incredible, and they do a remarkable job. And
they're still kind of facing headwinds in Asia too. That's still,
they pulled out of China this year.
Yeah, exactly. And the rest of Asia,
or at least the domestic business. So like the hosting business, but obviously there's people in China that can book outside of China, that kind of thing. But
right.
I mean, my only concern would potentially be some sort of consumer pullback in travel, some sort of lack of affordability causing average daily rates to come down. But like when I look at this thing 10 years out, just my gut reaction is I don't see how this is not a substantially bigger business. People like listing a room is becoming like a very normal part of culture in North America. Listing a room in your house, like it's not that crazy, which I don't know, blows my mind. It also gives me a little bit of optimism for Turo, which is kind of the premier ride sharing platform. I know it's slightly different, but it gives like I would have been skeptical in whatever 2010.
Excuse me, you said ride sharing, just for the listeners, car sharing.
Right. Yeah. Car sharing. It's like, I would have been skeptical about sharing your own property or whatever in like 10 years ago, but this has really kind of given me some validation that it's doable and these marketplaces can really succeed. I don't know. Do you have any concerns here? Aside from, valuation has probably jumped a lot, but I mean, couldn't you see this doing, I don't know, $15 billion in revenue in 5 years and more than 5 or 6 billion in free cash flow?
Yes, I could. I think I said once that I wouldn't be surprised if it's doing, $200 billion in GBV, which is gross booking value. And the big concern I had was ADRs, which is the average daily rate across their platform. And they've had a little bit of slowdown, but they've really grown through it. And it's only been quarter over quarter so far. So in Q4 2022, average daily rate was $153. And then in Q3, it was $156. I would be really interested to see what happens with that throughout the full year, because even if it stays flat and inflation is still high across the world, that's showing kind of a deterioration on a real basis of the ADR. But they do have a nice chart on Stratosphere that I'll pull up if What are your thoughts on that, Ryan?
Well,
on the ADR thing? Because it seems like if inflation's high, we shouldn't say it's going to go back to like the 2019 level, if you get what I mean.
yeah, and there was, I mean, even Chesky said kind of like you could expect ADRs to potentially come down. He said we anticipate slightly lower ADR than we had in Q1 of 2022 for this next upcoming quarter. And the other part he says here is for the remainder of the year, we expect ADR will face increasing downward pressure from mix shift. What?
I was going to say, sorry. I was going to pull up the screen and say I was wrong about the ADR being just last quarter. It's been basically a full year so far. If I'm sharing the screen here, we saw a huge bump during the pandemic. There is some seasonality, I guess, but now it's kind of trending back downwards a bit, and they're still growing that revenue. Yeah,
and I mean, the other thing that I really liked is they started to roll out this rentals business, or this like apartments business. So I know they only have like 175 apartments available right now, but you know, you've experienced this where last year you were renting out your apartment, or you were renting out of an apartment and you went to Mexico for 2 months. During that time, if your apartment had been Airbnb accepting or whatever, you could have rented it out, paid for your entire trip, and covered your rent by Airbnb-ing that thing. And I mean, that just seems like such a massive opportunity to go after. I think they're right in doing it. And it also has this, so it's good. More supply comes online. So there'll be more active listings potentially. Apartments feel incentivized to be Airbnb accepting because it will increase the likelihood that people want to rent from you because they know that they have better chance of affording it by being able to rent it out, that kind of thing. It's great for the actual renters themselves because they can afford it. It just seems like a win-win-win all across the board. And I don't know that they consistently find a way to like expand their addressable market and expand their active listings.
Yeah, and what's interesting is that they are facing, I mentioned headwinds from international. That's really just kind of a short-term thing as Asia, hopefully comes, fully recovered from COVID-19. But they are still facing multiple headwinds from just the regulatory stuff across all the cities with, who can list on Airbnb. And if they didn't have that, I think they would be growing even quicker. But I think on the flip side, the bullish part of that would be over time, you should hopefully, just because consumers want this, see steady demand over and over, or steady supply unlock from these regulatory changes where, like that apartment thing where I think it was 175 apartments across the country. So across the United States. So not that many, but you can see how that could grow over time. And yeah, I mean, it's just a great business. As we sit here today to wrap up this segment at a market cap of $74 billion.
That's what I was going to say, yeah.
EV, according to Stratosphere here, $68.6 billion. So let's just say $69 billion.
69 divided by 3.5 billion in free capital, right? Is what, 3.4?
Yeah.
20 times trailing.
I think, yeah.
There's no way that's right. Hold on.
I think their free cash flow can get changed because of the bookings. You know how the people will pay the money up front. So I'm gonna look
they've got like the working capital benefit.
Yeah, so let me look at operating income.
Yeah, and then they got that little stock-based comp, a decent amount of stock-based comp. Trailing 12 months operating income is, I think, 1.6 billion.
Yeah, possibly.
No, that's slightly behind.
No, that's not. Yeah, it's not updated. Yeah, I can get it. Full year. Yeah. I don't like to use their adjusted EBITDA because they're heavy SBC.
Okay, before you look at it, before you do the math.
Okay.
What multiple would you say this is going to the top of the watch list?
Where it gets interesting, quote unquote?
Yeah.
I think this is one where about 25 times I'd get interested. And it really got to there because typically we kind of look for unless it's something that's super high quality where we think they can grow forever, which is very, very few companies, or not forever, but grow at a high rate for many years. We like stuff that at least, if it's we think it has a competitive advantage, maybe around 20 times earnings or less. But for this one, I think this is kind of one of the few where I think it can grow a lot for a long time. I have it up here, 1.8 billion income from operations in 2022. So what would let's just say it's 2 billion times 2.5 would be a market cap of about $45 billion. I think I'm doing that math right. So I think in between,
the EV to operating income is probably like a little north of 30 right now.
Yeah, and what's unfortunate is that it got into the 25 times range in December for a quick period, but
you know what? During that time, we said this is a perfect example of, unless you really know the business well, price drives narrative. We were like, oh well, what about a travel pullback? What about
the Airbnb
ADRs compressing?
The supply stuff that people have been talking about, the oversupply, the ADR collapse that everyone.
Let me pose this. We talked about how real estate, and we're going to talk about Zillow here in a second. Real estate, we think, is in for a difficult period with potentially prices coming down. What if Airbnb is a beneficiary of that? What if more people need to rent out a room to afford their homes?
Well, yeah, some people might be stuck in those low, and it's not like a bad thing because they got a nice deal on their mortgages, but they might be stuck in that 3% mortgage that they've refinanced. I do not know the percentage of the country that's on that, but if they have that, they could, if they're moving somewhere, they might be like, oh, okay, instead of getting a condo somewhere, we could Airbnb a place for 3 months and then come and rent out our own place kind of deal instead of fully selling, because they don't want to take that loss if housing prices are either there's no demand because housing prices are so high, or on the flip side, housing prices are falling. We got a comment here. I haven't read it yet. Match Group and Airbnb are both platform businesses, but can we say not all platforms are created equal, at least in terms of profits/scalability? Good question from Sandeep. That's an interesting one where I think, okay, one, any of the platform businesses or say marketplace businesses that are online only, that do not have their own supply, like say an Open Door or inventory kind of deal, you should be able to have very, very, very strong margins if you do not require tons of marketing expenses, like a lot of maybe the other travel OTAs have. You see Match Group, you see even kind of a Bumble at some points. I know they're still kind of developing with their growth. You see someone like Airbnb. I'm trying to think of other marketplaces. I mean, Zillow's core marketplace, although
Uber,
they continue Uber, the core marketplace. I mean, here's the difference. They all should have really strong margins. And I think some might have better competitive advantages than others, like Airbnb might have a slightly stronger one than Uber, just because you could get a TAC locally if you're Uber. But Uber's is still very strong, and it's gotten much stronger than I thought over, a few years back it would get. But they should have really strong margins, and we've seen Airbnb here. Okay, we really scaled back our headcount, we overhired, and if you have a good business, if you have a good marketplace, you can really, really expand your margins. And I think Airbnb's margins could even go up. Match Group has strong margins as well. But compared to someone like Uber, and who's the other one you mentioned, Zillow, who have all these other initiatives, who have all these things like, Airbnb, they really got rid of all those other stuff during the COVID, which actually helped them a ton. And I don't know, when they streamlined the business, if you got insanely profitable. I just kind of wish Uber would do the same thing. I hope I answered that question, but I think profits should be the same depending on your marketing needs, because that's really the only cost here.
Yeah, I agree. Because especially once the platform's like up and running, like obviously you got to develop the platform, but
yeah, exactly. But it's really not, as if you can really scale it up internationally, it's not that much. I mean, that fixed overhead is fairly, really small. And the key thing here, I think, versus say a software as a service company, is that you do not need a direct sales staff. Your headcount as a percentage of revenue, or it should just in general, should be lower. Yeah, you got to spend a lot of marketing. Yeah, you have to have some marketing employees, but you do not need to hire 1,000 direct sales teams that you have to, give a bunch of bonuses to in stock-based compensation.
Yeah, it's the other thing is I think I'm getting to the point where I like platforms that don't have theoretically high margins. They have high margins already.
Wait for them to
Because
get there. Yeah.
it's kind of like I don't know, like if you've proved like a platform, especially like a two-sided platform or like a marketplace, works really well at scale. Airbnb is a perfect example where you want to put your listing on there because there's so many potential renters or customers, and then the customers want to go to Airbnb because there's so many potential listings. That works great. But if you're subscale, then you got to do you got to pour all the money into marketing, and you kind of like are constantly bumping up against that ceiling. So it to me, I think like I would probably be more open to owning the platforms that are already really profitable, because I know that they can benefit from their own scale.
Yeah. And it gives them more flexibility. It's interesting. And speaking of another one, you want to hit Zillow?
Yeah, this is I don't know, this quarter was blech. It was, I mean, they kind of are running into just like headwinds of the real estate market in general. They do better than probably the rest of the market, but this is one we visited a couple of times, and it feels like a business that's really not run for the shareholders. They pull new ways to lose money out of their ass every year, and it blows my mind. I don't know why they do it, because their premier agent business does well. Like
That's the classic marketplace.
it's a good platform, but I don't know. The quarter was okay. They had declining revenues as you'd expect. I think like the internet media technology, so that really the premier agent business had, I think it was like mid-teens revenue declines. But what really got hung up here was they lost a lot of money in their mortgages segment. So something that they've been trying to do is sort of add on mortgages to, if you're transacting through a home, or let's say you find like an agent or something, you can request a mortgage through Zillow, and then I think they sell the mortgage into the secondary market. But that's been declining basically this whole year. So last year, yeah.
And that's because mortgage demand has collapsed, right? Yeah.
Yeah, and it seems like even more so for them. I don't know if it's like they offer a shitty product or something, but $18 million in mortgage revenue, that's down 65% year over year. They're losing before taxes $51 million in that segment, which just like shrink the size of the business. Like, you don't need to, for something that's only generated $18 million in revenue, why do you need to lose $51 million? Just get rid of it. Like, it does not contribute that much to the business. Like, for reference, internet media and technology does like 400 something million in revenue. So it's, I've got it right here. 417 million in revenue this quarter. The mortgages did 18 million, but it has a ridiculous amount of losses. Like, you just don't need that. The part that concerned me is like the hypocrisy from this business. So, or from the management team. So there's a point that I was reading through this letter, they have a shareholder letter. And he basically said, we're different. Let me just keyword it. Our story is different. Yeah.
They're built different. That's what he said.
Yeah. So he says, from our perspective, it's clear that this past year we were simultaneously navigating the past and organizing for the future. Now we are fully eyes forward. 2023 is a consequential year for us, and it is all about making progress on our initiatives through product launches, market rollouts, so we can further expand and scale in 2024. Here's the part that's interesting. We see the same headlines you all see about tech companies cutting back their workforces to make up for staffing to accommodate unsustainable pandemic level growth that is now normalizing. Our story is different. After a year, they fired in October, they fired 5% of their staff.
Yeah, so they're doing the same thing as everyone else. I mean,
How's their story different? Yeah,
they bubbled into they became bag holders on the iBuying stuff. They just bought into that. Yeah, I mean,
they were the
look at
first ones
here.
to leave that, but they went from 8,000 employees to like 5,000 over the last year. And how's their story any different? They've done it.
Yeah,
Maybe they did it a quarter earlier. Does that make you really that much different?
yeah, I don't know. And if we look at this chart here, I mean, it's pretty telling. Like if you just look at their gross profit, compound annual growth rate since December 2013, so almost full decade at this point, through the end of this year, I believe, a compound annual growth rate of 27.5%. I mean, really, really good. However, they've never generated positive operating income. On when they had gross profit of $583 million in 2015, they had a negative $150 million loss, and over the last 12 months, it's been a negative $93 million operating loss on gross profit of 1.6 billion. I mean, it's just not great. It's just not great. You gotta,
No, and
they're
like I
big
said,
enough. They're big enough
ways to lose money.
Yeah, they're big enough where it's just this management team is just it's not.
Let's go
It's
through the
just not one that you
acquisitions.
could. Yeah, well, that's a disappointing.
Over the last several years, they acquired Postlets. We don't know the price. Diverse Solutions, Street Easy, Trulia, Naked Apartments, Showing Time. This quarter, they acquired ZMX Media, I think is what it's called. It's a photographer network
Oh
that's
boy.
meant to be like help people post their houses on Zillow.
Ah,
How much money do you think they've earned just purely through acquisitions? Probably all the cap. Like I mean, it gets consolidated, so it's hard to say like what that does, like what it's actually done within the business. But a lot of those, I imagine, are not that valuable to the business today.
yeah. Oh, I agree. Yeah. It
The other
seems like it's
part,
the same old story. We covered them on a not so deep dive, I believe, within the last year, if not maybe a little while ago. And that these are the same concerns we had then are appearing again now. So I don't think we should expect it to change.
here's the other part that just like kind of solidifies my belief, I guess, in the real estate market. And maybe there's a way that I'm wrong here, but I just don't see how. I mean, it seems fairly predictable, honestly. They said housing affordability challenges were the story of 2022 and remain front and center as we begin 2023. Affordability doesn't just impact demand, it also impacts supply. For homeowners, it's simply more expensive to move than to stay put right now, leaving more could-be movers on the sidelines. Just look at the mortgages business. Like mortgages, it feels, am I wrong to think this is really simple, that mortgages and applications for mortgages are declining rapidly because people can't afford homes? They can't afford them with higher interest rates, obviously. So either home prices stay exactly where they're at and they wait for the median income to catch up in
In
6-7 years,
Yeah, exactly.
or
Yeah.
prices come down or rates come
Yeah.
down, but rates aren't coming down. So prices have to come down or it's this waiting game with no home transactions for the next 5 to 6 years. So I just don't see, I don't know. It kind of just solidifies my belief that home prices have to come down a little bit. I do think at this point,
On a real they have to come down on a real basis, which they have been over the last 6 months because they kind of been flat and inflation's been high. But
still
again, that's not
affordability is low.
Yeah, let me just do some math here. So for anyone that thinks home prices aren't going to go down, all right, if you had a say, this is just an example, $425,000 house, standard 30-year mortgage, 20% down payment, at a 3% mortgage interest rate, your total monthly payment estimated, according to bank rate, is $1,779. If you change that to 7%, it's $2,600. So basically $800 a month in difference. There's not that wiggle room in the economy, especially among the young people purchasing their first homes. Either people are going to stop spending on everything else, or home prices are going to go down, or we're going to have a credit. Something has to give here.
Yeah, and I guess one of the other arguments is that home equity is the highest it's been in the US maybe ever. So people own a greater percentage of their home. Like the average home there's a higher percentage of ownership versus, 2008 time period. So a lot of people are probably reluctant to sell because they think, well, I got a bid for $500,000 2 years ago, and now people are quoting me 420,000 or something like that. Why would I do that? I can just wait another 2 years, and I'm not, I'm going to get the old bid. I think it takes time probably to rationalize that you're just not going to get that bid.
Yeah, it's going to be the classic biases will be there, the anchoring bias, all that good stuff. We can't, it's always there. So
Yeah,
I feel,
I feel like a doomer here by saying this, but doesn't it seem like pretty predictable? Like, if people can't afford them, if people are committing 50% of their paycheck to their mortgage and it used to be 30%, maybe you could say that's the new normal, but that's going to have ripple effects across the rest of the economy because there's less money to spend elsewhere.
Exactly. It's not just, yeah.
Pick or choose what you want. But
all right, Zillow market cap's 10.6 billion, EVs similar according to Stratosphere here. Says I don't think they're priced, and we can't really do a good like they don't have any good metrics.
We got to get those red flags on Amazon, those mini red flags when something shows up.
Yeah, they are cheap. It's like $10 for the soccer ones, which will put
the red card.
Yeah, for a Zoom call. But what market cap? Because at any price, a stock gets interesting. Eventually, you get down to below the asset value. At what market cap would you be interested in Zillow with its current management in place? Say they're going to still be there, like they're not changing.
No, it would take. I mean, it got there at one point. Like, if you would have had, you could say 2 times IMT revenue.
It's
right?
Not that far above. I mean,
how much is the business worth that never generates cash?
Yeah. I don't know.
There isn't a price, right?
Yeah, I mean, it was at $48 a share, and it is at today, and it got down to around, say, just below 30 a few times. It's really not that far off the highs. I think I'd be interested in I think with this management team, who I just dislike, I think $4 to $5 billion market cap. I'm interested in doing some work, but Ryan, you're shaking your head. You say never. This is one you just don't touch on.
I used to think there's a price for everything, yada, yada, yada. If it can be as shitty as it can be the worst business in the world, but if it's cheap enough, I'll buy it, that kind of thing. Like, no,
it's got to be. Well, so you're saying
there are a bunch of companies that I would never buy. If I firmly believe that they don't care about generating cash, and I'm not able to take over the business, and if I'm not able to buy the whole thing, I'm just a minority shareholder, then it's not worth buying it.
Yeah, exactly. Where, okay, you can say eventually, Zillow, and it might not be the best metric to use, but eventually, it could go below book value. And you could be like, wow, Zillow trading below book value, internet business. But if they're going to destroy book value, then it's probably worth less, as they've continued to do. Although I don't know if book value is higher or lower. Basically, if they're going to destroy intrinsic value per share, which right now it's nothing, they're going to continue to destroy it. Then, yeah, I mean, what is it worth? You could have the cheapest stock in the world, and if they're destroying capital, it's just not going to work over time. What's crazy, and this is why management matters so much to us now, or we've kind of learned to really have that be so important for us over the last few years, is we would much rather have, say, a business that's quote unquote not competitive, not a huge competitive advantage, or not this perfect thing, but if it's trading at 4 or 5 times earnings with a management team we think is going to allocate capital rationally, then there could be some real opportunities there, because that can make a stock work real quick, especially if they turn their earnings into cash flow.
Yeah, and I mean, if you just get the sense that like the management team doesn't care about growing, like if they just are shareholders, but they constantly get new options, they're constantly selling stock, they're pretty rich already, they're happy with their life, and they care probably more about influence and like having sort of a good reputation with their company, and being this, I don't know, just getting bigger at any cost, that kind of thing. Like, that's not someone I want to partner with. And it's pretty clear who are like truly shareholder friendly allocators, because you can just look at their history.
Yeah, look
And
at the action. I mean,
Zillow isn't one.
compare Zillow and Uber to Airbnb. Airbnb used to be in that camp. Remember, they talked about it. There was a huge change, and it took a pandemic that wiped out their demand by 90% to get them there, but they got there, and now they found that religion. And yeah, all right. I think that's enough talking on the new topic. Oh, we got a comment here again from Sandeep. Thank you for being one of the 5 watching. Got to give him a little credit for pulling out of iBuying at least earlier than Redfin. Open Door, probably going to 0. I would say the base case should be Open Doors going to 0. Anyone has a good? I've never heard a good argument against that. You're just flipping houses, and if housing prices go down, it's over. Yeah, I guess you could say Zillow is good pulling out of the iBuying business first, but it's kind of a company we know well is Spotify. They have that same issue of going into businesses that are trendy at the time within their industry, and it's kind of like saying, okay, they bought that tiny Clubhouse competitor and started it, and now we're going to just kind of throw it to the wayside and give up on it. And it's like, yeah, you probably should have seen that it wasn't going to be a big thing. And yeah, it's not going to be giant shareholder destruction versus Zillow's, who lost a lot more money than they did. But I don't think we should give them too much credit, because if you really know the real estate business, if you really know online real estate, as Zillow should be the number one expert in that, you should have known that it wasn't going to work.
Yeah, I mean, it is. That was kind of my thought initially too. Was like, whoa, they got out of it before everyone else. But then when you just like really think about the actual business itself by buying, especially for people that know the real estate business well, as Brett mentioned, you should have known this was and people did. Like, people knew this was a bad business from the start, because you're throwing in low ball offers, which means you're probably getting the worst assets to begin with. If people are selling you, the whole thing is margin of safety, right? On the iBuying business. So you're trying to buy the worst or at the cheapest rate you can under market, so that you can turn around in 30 days and resell it. If someone's, especially in an up market, if someone's taking your bid on a low ball offer, there's something wrong with that house, probably. Now you could say maybe like it's a liquidity thing and people want to get rid of it fast, but how many people do you really know they're trying to get rid of their house in like 10 days?
Who cares? Yeah, no one cares that it takes 2 months for them to get out of a house at the fastest.
Yeah, and then you've got all that upkeep costs. I think people were under, every iBuying business is go ahead.
Holding the inventory on the balance sheet. I'm gonna say.
Yeah, potentially you have a declining market where you're holding the inventory and you're getting less bids for the houses you offer. But on top of it, even in an increasing market, if people are buying your offers, then you're probably getting bad assets, you're getting bad homes that you have to turn around. Maybe the occasional one is just them trying to get out of it quick, but I would say that's kind of an edge case.
Yeah, I agree. And it took me a while to really understand Open Doors business model, because I kept overthinking it. But after thinking about it a little bit more and then watching Margin Call, I think again, where I was like, oh, it's the same thing. They have these assets on their balance sheet that create real risk. And if they become lower in value with the leverage they put on now, they didn't put as much leverage on as, say, Lehman Brothers. But either way, if the asset values go down as they have, and I think they've lost, money on so many of their homes, it's not, the business model doesn't work, because you're basically just becoming a house flipper at scale. So you're really just betting on housing prices rising with much, much more overhead than an individual buyer. And it made zero sense from the start.
Yeah, I think like maintenance and rehabbing costs are a really big part of this business to understand. I think a lot of the iBuying businesses kind of overlook that. But we've been talking on this for probably too long. Do you want to talk about Upstart? Because this was a
Upstart
rough
could be
quarter.
fun. Yeah, Upstart could be fun. I saw the stock was up though, but although I looked and then I kind of did the zoom out thing on like last 5 days, it's up 20%. Over the last 6 months, it's down 45, and over the last year, it's down 86. I was like, oh, well, it's not really been that good for them. But yeah, well, I didn't look at the quarter at all. What happened? Was it really bad?
Yeah, I mean, technically they beat guidance. It seemed like they had like kind of sandbag guidance or whatever. But their upcoming guidance or their outlook was like, I think Brad Freeman, friend of the
Stock market
show.
nerd friend. Yeah.
Yeah, he used a good term to describe it as putrid, and I think that's probably a good. I think that's a good description. It was basically they're guiding for, I think it was minus 68% revenue growth in this quarter. You can see what's happening to the revenue and the contribution profit, but some of the more concerning things are like the amount of loans they're personally having to own or hold on their balance sheet. So year over year, the number or the dollar value of loans that Upstart has on its own balance sheet, because typically, for those that don't know, Upstart was they're meant to attract the borrowers. They offer these credit ratings, or they offer these lending terms to the borrowers. The borrowers accept.
Hey, are you
Upstart
saying
maybe
are you saying you know what the business model is, Ryan?
I do. Unlike I'm not gonna say his name, but they'll take those loans and they'll sell them into the sort of the secondary market. Other companies, other financial institutions will kind of take the actual credit risk. However, this quarter, Upstart recorded $1 billion in loans on its own balance sheet. That was up 4x from last year. So
What about Q over quarter? You had that or no?
up 310 million. So it was 700 million last quarter. This is like it's just a different investment. You have to really believe that, I mean, they're now taking the credit risk. So you have to believe that these loans are super high quality. It was pretty easy at the start to say, who cares if the loans are low quality? They're not the ones taking the financial risk or whatever. Obviously, the institutions probably stop giving them money, but at the end of the day, if there's some big catastrophic event, they're not the ones that get ruined for it. Now there's that risk. So I don't like, to me, and not all of them are the consumer loans. I saw that there's like a different breakdown, but still more than the company guided for to take onto their balance sheet are consumer loans. So it sounds to me like less financial institutions are willing to take these loans. That's not surprising in a higher interest rate environment, but I think Buyback Capital, who we recently had on the show, described it well, which is this kind of model doesn't fare well in an adverse environment because they are trying to lend to the people that are historically hard to lend to. Whereas you take someone like FICO, who is trying to be as conservative as possible and lend to the people that are clearly lendable. So, or I mean, they're not lending, but Score, they're trying to be very conservative on the credit determinations. Upstart's trying to find reasons to kind of take the edge cases and make money on them. That's a much riskier model when rates skyrocket. I don't know. This quarter looked bad, and then the stock jumped 25% the next day. So,
yeah, it's just that EPS stuff.
I've also heard murmurs of something like a short squeeze or something like that. So we don't dabble in that.
I hear, yeah, I've seen they have high short interest, but
yeah, I don't know.
That just means it's gonna go. If it's a short squeeze, it means it's just gonna go down.
What do you think of? Did you read the Roblox quarter at all?
No, but I want to share a screen quick on Upstart, showing a little stratosphere chart. This is, I think, because when you look at the numbers on the table, you can kind of convince yourself and go through things. I mean, we all do it. And when you can visualize each quarter or each whatever metric you're doing and kind of say, oh, things are trending in the wrong direction. As we've seen, there's a reason Upstart stock is way down. It's because revenue has gone from quarterly revenue in December 2021 was 300 million. First quarter of last year, 310 million. And now in the Q3, which they haven't updated this on Stratosphere yet because it's too early. It's only been like a day. Q3 revenue was only 157 million. What do you have for Q4, Ryan?
Less. It's less, and the guidance is less too. So it's continuing to decelerate. But the other part that concerns me is cash provided by operating activities was cash flow provided by operating activities for 2022 was negative $675 million.
Is some of that working capital or no?
Maybe, but a lot of it's also just hemorrhaging money and stock comp, or just hemorrhaging money in general, purchases of loans. So I don't know. It's a complicated financial statement, but I can't do it on the fly. They're burning through cash is just the way to look at it. And even if they're burning through less cash, they're still burning cash. Even if you take like the most optimistic scenario, they're buying back stock this quarter.
Really?
They repurchase stock.
They believe in themselves, I guess. This could, this could be the trough. Who knows? What's the market cap right now? I'm seeing 1.6 billion. Who knows? This could be a $10 billion business. I guess we could look like fools. But I'm okay with that.
It just, to me, like, I used to think like, oh, they're buying back stock. Great. That's a great sign. But I think a lot of businesses, it'd be better for them to have the cash.
It's not a perfect metric for
Bed Bath and Beyond to kill them.
Yes, exactly. And other
died anyways, but yeah.
All right, Roblox, last one.
Sears did that too. Yeah. Roblox
Sears.
This is a pretty good quarter, I guess. The daily active users, I saw someone online, they said revenue was basically flat. It was a terrible quarter, but
they had the bookings thing, right? How was bookings?
Bookings were up 17% year over year. So
okay.
Solid quarter all around. I thought daily active users in January, which I guess wasn't included in the quarter, but they gave the numbers anyways, 65 million average daily active users. I find that kind of astounding. Up 19% year over year. The bookings per DAU was basically flat in January. It was actually down on a constant or on a reported currency basis in the quarter, but basically everything's looking good. My only concern here is they've very clearly said we're going to keep investing in our infrastructure. So they built their own data center, I think somewhere on the East Coast. They have invested a lot in engineering talent. They just don't, I don't know. They don't seem to care that much about shareholders is my, when I look through this, it kind of like, it just doesn't seem like shareholders are their first priority.
Yeah. It's I don't know. It's hard because for one, they have a giant market opportunity. They continue to outpace the broader video game market. They want to build this quote unquote metaverse stuff, and it's going to take a lot of investment, and they do not need to spend that much, if I'm aware of, on sales and marketing. So there could be a time when they get a sort of R&D moat, which I know are kind of tough to come by, where they've spent so much on all this engineering talent and the cloud, whatever, all their infrastructure that they built, and that could make them much, much better than any sort of upstart competitor. But on the flip side, they might not be profitable they might be break even for a long time.
They do have like 3 billion in cash. So
yeah. And they've proven that they can generate cash if they pull back a bit, which I like. I just, it's a little, I could see them being such a big business. It's just one where I kind of throw up my hands and say, I have no insight into what their market will look like 5 years from now. How many people in India, how many people in Australia are going to be picking up Roblox? How many kids are going to do it? How many 24-year-olds are going to start playing
17 to 24-year-olds? 17 to 24-year-olds were their fastest growing age demographic.
I know, I see that now, but I wonder what kind of the ceiling of that is. Is it lower? Is it higher? I mean, it's just because those are going to be their bread and butter from a spending perspective. would be the young adults who can spend more than, let's say, $50 of allowance a dad gives their child for Roblox a month.
Here, you want me to scare you? $2 billion in revenue, 2022. Obviously, bookings is probably the more important figure, but whatever. Yeah, it's just a lagging metric. 600 million in stock-based compensation.
Whoa, that's high. All right. Yeah.
That's like a quarter of revenue.
Yeah. We got to incentivize our people. That's what do they all say? We got to incentivize.
Don't you think
our
it's like
people
a
to
bad
stick around.
incentive though?
I know.
If you give them a bunch of stock and then potentially the stock tanks, like
yeah, I think it's
like a backwards incentive.
Yeah, what
they probably have very, very low motivation to work.
All these executive teams, not all, but so many that we look at have compensation consultant derangement syndrome.
Yeah.
It's pretty lame, I think.
Let's talk Munger. We got 10 minutes.
Okay, yeah. Daily Journal annual meeting. He continues to, I wouldn't say go off the rails, but not really care what he says, because he did say he said something like the old Coca-Cola CEO was showing up drunk and the business was still good. And he's like, that's a damn good business if the CEO is showing up drunk. And I was like, all right, well, that's interesting. You just outed that guy. And he said something about, look, he's 99. He said some things that I was like, is he saying something racist right now? But
he used a word that I'm not familiar with. It is not racist, but it's definitely out of like the word.
Yeah, look,
it had a bad word in it, but it did not mean anything racist. It meant like
look, it's
ungenerous.
Fine. I'm surprised people don't talk about, in kind of the general world, don't ever get up in arms about him, but maybe it's just he's too nation. We kind of follow him and no one really follows him. Either way, besides that, I think, again, he was asked about crypto and he's getting even more negative about it. He called it, and this is something a grandpa would do. He starts laughing after he says it. He calls it crypto crapo, which he was like, ha ha ha. So funny. It's really not that funny, but he thought he was clever.
He's very old.
Yeah, he is old. I'm guessing it probably plays well at the retirement communities. I mean, he said the same stuff about crypto. He said that the government should ban it, and he
almost choked when Becky Quick said they own Disney
because doesn't.
Yeah, they're like, you've owned Disney at the Daily Journal or whatever, and I think he was like eating peanut brittle, and he like started like coughing and choking. And he's like, we've never owned Disney. So it almost sounded like he was like disgusted at the thought of owning Disney. But no, he talked about Disney for a while. That was pretty interesting.
Yeah. They're facing a lot of competition. We'll see if they can come out of it. Berkshire has, I think that's probably where she was confused. One thing though, the man, did you watch the whole thing?
No, I did not.
The man loves China. He loves them. Every time he would say something like, oh, in China, they're doing this. Oh, in China, the people are like this. And it's like, look, he loves it. That's all I'll say. But he talked about BYD being better than Tesla. I think it's kind of, an under the radar company that Berkshire took an investment in. They're crushing the EV market in China and kind of expanding globally. And they really have some of that, battery tech and all that stuff, all that good stuff. Do you think, and he was the first one to admit that, he said as well, his Alibaba investment was the worst one he's ever made. Do you think having an investment in BYD, basically the best technology company in China, clouds Munger's judgment about the rest of the country? Because it'd be kind of like if you were from China, you come to America in 2005 and you make a giant investment in Apple, and that's kind of the company you have a giant relationship with. And you're like, wow, this place is amazing. Like, these people can do, nothing wrong. And BYD, from all intents and purposes, probably has some of the best engineering talent, the best technological talent, research talent in the world. But that doesn't mean, I don't know. It seems like, you can kind of get clouded by the 1% of the world you see versus the 99% else that's out there. So I kind of think that, That could be something with there. But he did, I really don't get why people were so upset about Baba. I guess I would be maybe upset about people just blindly following him because it seemed like a lot of people started doing that, big investors and small. Saw a lot of 13 Fs with Alibaba in it. And he kind of just went, he had no grips, no excuses. He just said, yeah, it was a mistake. I shouldn't have done it. And then he was like, yeah, moved on.
Yeah, I think it's impressive. I mean, there's maybe BYD clouds his judgment on China. I think his love for Li Lu probably
Yeah.
helps too. The other thing is, I mean, if you look at like just the production growth in China over the last 40 years, it's hard not to be like impressed with the results.
Over the long term. Yeah. Yeah. Who
But
knows?
that was
We
also
could be wrong.
because I remember I forget where I was reading it, but like they had a pretty low base because whoever it was, the
Mao Zedong.
ruler before was kind of trying to prohibit.
He may have been very, very bad and caused 10 million people to die. Yeah. Or more. No, I think it was 50 million from like the farm stuff they were trying with agriculture. It was bad. Yeah. So
he was very anti, like, I guess, research and development, it seemed like.
Yeah. What was
so
it
once
called?
they turned that on, there was just a lot of, I think, latent productive capacity or human ingenuity that they could tap into. But yeah, I'm not sure what his fascination is there. I did see a stat though. BYD, apparently Munger said that their $270,000 investment in BYD is now worth $8 or $9 billion.
Yeah. They're getting better returns than Musk and Tesla, which is funny.
That's wild. 33,000x.
Yeah. And I think they put in more over time, if I'm not, but I also could be wrong. I do not follow that part of the business closely. And there's people that follow Berkshire a lot closer than me. Or was he talking about Daily Journal?
I'm not sure.
No, not Daily Journal, because Daily Journal's not. They're a small cap.
Yeah, I don't know. Sometimes I watch these things and I think like, yeah, Charlie's smart, but maybe we got to stop listening to him at this age.
Yeah, I know.
Like,
I think it's kind of funny.
I love listening to like him in the early Berkshire meetings, in his speeches that he's given. I mean, you can obviously tell he's like one of the, I think, probably smartest Americans to live, but at some point, 99 years old is 99 years old.
Yeah, and they ask the same questions over and over. Like, what is your morning routine? It's like, he's like, I get out and get in the wheelchair.
Yeah.
What someone asked him about how do you live a long life? And he said, I never exercise and I eat peanut brittle all day. I was like, yeah, why are you asking this man that? He sits down all day and eats candy. He's an anomaly.
Yeah. I think him and Buffett are both anomalies.
Yeah.
Impressive. For sure.
Yeah.
It is hilarious sometimes to see the people that have like dedicate their every waking moment to trying to live long. And it's just like kind of like not a great way to live, but they're living for a long time. And then you see it's like Buffett and Munger.
Yeah.
But what about Roku earnings? We got like 2 minutes. Overall thoughts?
Let me pull up the letter. Let me just give the overview numbers. Active accounts up 16% year over year, hit 70 million streaming hours, grew quarter over quarter and year over year 23%. So everything looks fine there, but the monetization is slowed down. Platform gross profit, which is their advertising / services, software services segment. Gross profit down 4% year over year in the quarter, and platform revenue was only up 5% in the quarter. I think the fears for Roku on monetization, on how that we kind of had, and a lot of other people had, and we kind of came to this conclusion later, luckily, is that they just didn't execute well on the monetization strategy. I mean, they've executed somewhat well. I mean, the business kind of came from scratch 5 to 7 years ago on that side, but it's stalled out the last year or two.
Yeah. I always think like, man, this has like obviously a ton of potential, but it's just too hard of a problem to solve, where like it's really tough to say whether they're going to have a whole lot of like platform leverage over the big media providers. Are
I
they
agree.
going to get? Are they going to constantly get squeezed? Because maybe you're never going to see the cash flow if that's the case. They could be
how
in every
many-
house in America, and maybe they just don't have the negotiating leverage.
Yep. How many accounts do they need to get? Is it 200 million before they get that leverage? Who knows? All right. Well, that's going to do it for this episode. Ryan, anything else before we head out of here?
There's your earnings palooza. I know we probably missed a bunch, but hopefully
There are a lot out there. Yeah.
we won't bore people with earnings every week, but I want to do it at least once in earnings season.
Yeah, I think it was fun. We just keep the numbers low, kind of go for overall stuff. I think it's fun. All right. That's going to do it for this episode. Few key housekeeping items before we leave. If you're a regular listener, subscribe to our free newsletter and get our show notes and charts for each not so deep dive episode, along with our Sunday Finds newsletter, and the link is in the show notes for all these episodes, or you can search Chit Chat Money on Substack. If you like watching these episodes, you can do so on either YouTube or Spotify, or not these are only on YouTube, but either way, you can watch the replays on YouTube or catch us live at 12:30 p.m. Eastern time. And if you enjoy the show, give us a review on either Spotify or Apple Podcasts. We are
We're
not
also on
financial
TikTok
advisors.
now.
Yeah, Ryan's posting some.
I'm
you got
feel like an old man, but
you got
posting
3 on
a couple
there.
TikToks.
Yeah, and they're just clips from these episodes. So if you like them, go follow us there either way. But if you're already watching, yeah. All right. We are not financial advisors. Anything we say on this show is not formal advice or recommendation. However, we are general partners at Arch Capital, and clients may hold securities discussed in this podcast. Thank you, everyone, for tuning in. We'll see you next time.